Hi, I'm John Levy of John B. Levy and Company. Happy New Year, and welcome to our ongoing series of podcasts on the commercial real estate market. When I say Happy New Year, this year I really mean it, because 2008 was a tough year. In fact, for many of us, it will be a year that will be easy to remember, but frankly, best forgotten. When the folk group Peter, Paul, and Mary sang their famous anthem, "Where Have All the Flowers Gone?" we doubt that they had the 2008 liquidity crisis in mind. But who knows? They might have, because it seems like the liquidity disappeared virtually overnight. We're not sure exactly what happened to all that liquidity, but a good place to start looking for it would be the $7 trillion, trillion with a T, that disappeared in the stock market alone. We're positive that $7 trillion loss has caused a credit crunch the likes of which most of us have never seen. So what does 2009 hold? Well, of course, that's anybody's guess. But if it's up to us, we suspect that it will look a whole lot more like 2008 than the glory years of 2007 and 2006. If our thoughts are right, we'd like to share 3 ideas with you for making money in 2009. First, if you're a developer or user of capital, have realistic expectations. After all, we're in the midst of the longest recession the country's had since the Great Depression of the 1930s. This is really not a time for aggressive or liberal underwriting. With respect to leverage, we suspect you'll see loans in the 60 to 65% range, not in the 75 to 80% of value range that most borrowers grew to know and love in the 2005, 2006, and 2007 go-go years. If you're planning to borrow from a bank, banks require either full or partial recourse, and for the most part, that's unavoidable. If you want to avoid recourse, you'll be dealing with an insurance company or a pension fund. And if you have your heart set on an interest-only loan, plan on having your heart broken. Those are essentially not available today. Most loans carry amortizations with terms of 25 to 30 years. If you're a player in the CMBS market, I don't have to tell you that 2008 was a terrible year. It was ugly. 2008 volume was down over 90% from 2007. And frankly, don't look for any rebirth in 2009. But we do think, being somewhat optimistic, that the CMBS market is not dead forever. Securitization is a powerful tool, and it will come back, perhaps with some structural changes. But what are you to do if you're a developer and you have a loan that has come due and it's a CMBS loan? What about getting a loan extension? Because after all, in your case, you can't refinance your loan elsewhere. Well, don't panic. CMBS servicers are not in the loan-to-own business. In other words, their first goal is not to foreclose. Most special servicers are empowered to extend loan terms, change rates, and make other modifications. But remember, their first choice is to have the loan paid off. So they will give you an extension that, at least in their mind, makes it somewhat uncomfortable for you to continue with their loan. What this means is you can expect a higher interest rate, perhaps additional cash equity asked for, or principal amortization. In other words, don't worry that they're going to take a grab for your property first, because they'll probably want to make an extension for you, even if it's not an extension that you call terrific. Even with the current credit crunch, now's an excellent time to leverage good multifamily products. Thanks to Fannie Mae and Freddie Mac, multifamily are the only assets which have even a semblance of normality in these trying times. Let me give you a few examples. Leverage. Instead of the 60 to 65% that we talked about previously, multifamily loans are available at 75 to 80%. And rates are cheap. Fixed rates are available in the 6% range, and floating rates are available at 4% and lower. Last, these loans are substantially non-recourse. And that's true whether you're dealing with Fannie Mae, Freddie Mac, or institutions like pension funds and insurance companies. So what does 2009 hold? Well, we're not sure, but we do have three thoughts. One, be realistic. Two, know that CMBS loans can be extended if necessary. And three, leverage good multifamily products now. They are available at very attractive rates and leverage. I'm John Levy. I thank you very much for listening to our ongoing series of podcasts on commercial real estate. We hope that you'll either call, write, or email us. You can reach me at jlevy@jblevyco.com or by phone at 804-644-2000, extension 237. Thank you for watching.